Welcome to the Tesla Daily News podcast for February 20, 2026. Today, we're tracking three themes that can move the stock: autonomy, safety, and regulation, Tesla's Robotaxi product timeline, and the global charging ecosystem that keeps expanding around Tesla. First up, Tesla just avoided a very real sales disruption in its biggest US EV market. California regulators were weighing a 30-day suspension of Tesla's dealer and manufacturer licenses, but Tesla sidestepped that outcome by changing its marketing language and removing the term Autopilot from California materials. Multiple outlets and Reuters reporting point to the same core fact. The DMV's concern was that Tesla's terminology could mislead drivers about capability and safety, and Tesla made corrective changes to comply. The impact for investors is straightforward. California is a high-volume, high-visibility market for Tesla, and a temporary license suspension would have been a headline-driven shock to deliveries, revenue timing, and sentiment. Avoiding that cliff is a near-term de-risking event. The takeaway: this doesn't eliminate regulatory scrutiny of driver assistance, but it reduces near-term operational risk. Watch for whether Tesla extends the same terminology cleanup beyond California, and whether it changes how it sells or packages full self-driving, which is still central to the long-run valuation story. Second, the Robotaxi narrative took a hit, and it's a hit that matters because autonomy is one of Tesla's biggest implied value drivers. New reporting citing NHTSA data says Tesla's Austin Robotaxi service has logged 14 collisions since launching in June 2025. Several stories highlight the same comparison. The crash rate is estimated at nearly 4 times higher than human drivers on a per-mile basis. One report also frames recent updates as 5 additional crashes logged over a recent period, contributing to that total. Context here is important. Tesla has long argued that autonomy improves safety, lowers insurance costs, and ultimately enables a high-margin, software-like Robotaxi business. If the early real-world data looks meaningfully worse than humans, that creates 2 immediate problems. Regulators can tighten oversight, and consumer trust can erode. What could this mean for the stock? In the short run, it pressures the autonomy story that supports premium valuation multiples. It can also raise the probability of new restrictions, required reporting, or investigations, all of which tend to weigh on sentiment and increase perceived risk. The takeaway: investors should separate 2 things. One is the pace of progress. Tesla can improve quickly with software. The other is whether the current deployment is ready for scaling. The market will care less about a prototype phase and more about whether the safety curve is bending decisively in the right direction. Third, Tesla says the Cybercab is real. At least one has rolled off a production line, but roads are another matter. Several reports claim Tesla has produced a first Cybercab unit at its Texas facility. The big headline detail is the concept: a 2-seat Robotaxi designed without a steering wheel or pedals, and a price point discussed around $30,000. That's a major strategic signal because it suggests Tesla is attempting to industrialize its dedicated Robotaxi platform, not just run a service using modified Model Y vehicles. But the other half of the story is just as important. Reporting also says it still won't be released onto public roads yet. That's the key investor implication. Building a vehicle is one milestone. Getting the regulatory approvals, safety validation, and operational readiness to deploy at scale is the harder milestone. Impact: if Tesla can truly build a low-cost, purpose-built Robotaxi, that could be margin accretive over time and strengthen the long-term autonomy thesis. But given the Austin collision data we just discussed, the near-term market reaction may be cautious. The takeaway: watch for concrete timelines, geofence deployment details, and any regulatory framework announcements that would enable driverless operations without a human fallback. Fourth, Tesla is leaning into scale and credibility on full self-driving data, and that's a double-edged sword. Tesla disclosed that full self-driving supervised has now surpassed 8.2 billion miles of cumulative driving. That's an enormous dataset, and it strengthens Tesla's argument that its system is improving through real-world exposure and training. The context is that autonomy competition is partly a data and iteration race. More miles can mean more edge cases captured, faster model improvement, and ultimately a better product. The impact for investors: this supports the long-term narrative that Tesla can iterate its way to higher capability, potentially enabling higher attach rates for paid software and, eventually, Robotaxi economics. But here's the double edge: the market will increasingly demand that Tesla translate that scale into measurable safety outcomes, not just miles driven. The takeaway: watch for metrics Tesla can stand behind, like disengagement trends, incident rates, and performance by environment, because billions of miles are most valuable when paired with transparent safety improvements. Fifth, charging remains a quiet but meaningful advantage, and Tesla's standard is spreading. In Japan, reporting says the industry is beginning to adopt Tesla's charging standard, a sign that Tesla's connector ecosystem continues to gain acceptance beyond North America. Separately, Tesla is expanding its supercharger footprint internationally, including a newly added Istanbul location in Gürpınar. Context: charging reliability and standardization reduce consumer friction and boost EV adoption. For Tesla, broader standard adoption can translate into more charging revenue, better utilization rates, and increased strategic leverage as other automakers and charging operators plug into Tesla-compatible hardware. Impact: charging isn't Tesla's largest revenue line today, but it can meaningfully support the overall ecosystem, strengthen customer loyalty, and contribute to services-style revenue over time. The takeaway: investors should track not only new station openings, but also where Tesla's standard becomes the default, because that can lock in long-term network effects. Sixth, competitive pricing pressure is still alive, and it matters most for margins. Hyundai and Kia reportedly cut EV prices in South Korea, explicitly responding to price cuts from BYD and Tesla. That's a reminder that the EV market is still in a competitive phase where pricing moves quickly. The context is that Tesla has previously used price to defend volume and market share. That strategy can support deliveries, but tends to pressure automotive gross margin, especially if competitors match quickly. Impact: if price competition intensifies across regions, Tesla's margin trajectory becomes more sensitive to cost reductions from manufacturing efficiency, battery cost, and scale, and less dependent on pricing power. The takeaway: watch Tesla's regional pricing, inventory signals, and any manufacturing updates that indicate continued cost-down momentum, because that's the lever that can offset a tougher pricing environment. That's the show for today. The big themes: Tesla reduced near-term regulatory risk in California by changing Autopilot marketing, autonomy faces new scrutiny as Robotaxi crash data circulates, and the Cybercab production milestone raises the long-term upside but doesn't solve near-term readiness. On the bullish side, Tesla's 8.2 billion FSD supervised miles and continued charging standard momentum support the ecosystem story, while competitive price cuts remind us margins remain a key battleground. For tomorrow, keep an eye on any updates from regulators or the NHTSA around the Austin Robotaxi program, and watch for any new details from Tesla on Cybercab deployment timelines or additional marketing and compliance changes. If you found this useful, subscribe to the Tesla Daily News podcast and follow us for a clear, data-driven update every trading day.